The first 14.6% autocallable income ETF hits the U.S. retail market. What in the world are autocallables anyway? Hello, member super savers and bond course fans. I hope you're healthy and well and enjoying your summer wherever you may be. As many of you know, we just got back to New York after a few weeks in Taipei, but that doesn't mean we haven't been keeping track of the comments and questions on this channel. In fact, today's video is based on a member comment from one of our recent weekend updates on the big, beautiful bill. Off the Trump topic, do you have an opinion on Calamos' Autocallable Income ETF? Seems fairly new, and I know you personally prefer to do your own trades, but your thoughts would be appreciated. So, with that in mind, here are the three topics that we'll be covering in today's video. 1. What is the Calamos Autocallable Income ETF, ticker CAIE? 2. What are autocallables and who issues them? And 3. How do autocallables work and what are the risks? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What is the Calamos Autocallable Income ETF, ticker CAIE? Those of you who've seen our 4-part member series on Boomer Candy ETFs, funds, and notes, link below in the first pinned comment for reference, should already be familiar with Calamos. They are a privately held investment firm founded in 1977 by John Calamos Sr. and headquartered in Illinois, with offices in Chicago, New York, San Francisco, Milwaukee, Portland, and the Miami area. And if we scroll up, we can see that Calamos currently has 368 employees and $42.9 billion in assets under management, including $19.4 billion in liquid alternatives. So, the Calamos Autocallable Income ETF, ticker CAIE, is a brand new product that just launched at the end of June, meaning there's really no track record to speak of yet. At the time of this taping, CAIE has total assets of $46 million, an expense ratio of 0.74%, and a weighted average coupon of 14.6%. Now, this 14.6% weighted average coupon at the time of this taping was enough to catch our eye already. But then, Calamos goes on to show this chart on its website, highlighting that over 20 years, between May 2005 and April 2025, the Mercube US Large Cap Vol Advantage Autocallable Index, the autocallable index that CAIE is based on, would have produced distributable income at a yield of 12.87% per year, while at the same time generating a total return of 9.97%. So essentially very close to the total return of 10.1% that the S&P 500 Total Return Index produced over the same time, but with a much higher share of distributable income, or cash, 12.87% coupons on average for the autocallable index versus only 2.12% dividends for the S&P 500. Now, our Diamond NestEgg regulars know that such high distributions and returns will always be associated with proportional risks. After all, one of the fundamental rules of investing is higher risk, higher return. So we immediately got curious. What are the risks that you would take with CAIE and its autocallable index to generate this 14.6% weighted average coupon at total returns that are very close to the S&P 500, bringing us nicely to the next section of today's video. What are autocallables and who issues them? Autocallables are exchange-traded notes, meaning that they do not represent ownership in an underlying asset, but are essentially unsecured senior debt of the issuer. As such, they do carry credit risk. If the issuer of the autocallable gets into financial difficulties or even defaults, the promises may not be worth much and you may lose your entire investment in the worst case. I'll refer to them as autocallable notes, autocallables, or sometimes just notes in today's video. From what we could find, autocallables were first issued in the early 2000s in Europe and have long been popular investments for high net worth and ultra high net worth investors in both Europe and Asia who are looking for extra yield or income in what have often been low interest environments. Over the past few years, autocallables have been growing fast in the US as well. Why would an investor buy autocallables? Calamos formulates the sales pitch for autocallables as follows. Think of it like a bond whose income and principal depend on the stock market not falling too far. At the most basic level, this is not wrong. If everything goes in the investor's favor, the autocallable will pay a consistently high coupon over its life and then return the full principal at maturity, just like a bond. As the name autocallable indicates, though, an autocallable may automatically be called early before its maturity date when certain conditions are met. Callability is a feature that many of you are already familiar with as bond investors. So even this fits with the overall description of an autocallable behaving like a callable bond, whose income and principal depend on the stock market not falling too far. The twist with the autocallable, however, is this added feature that both the income, the coupon payments, and the principal depend on the stock market not falling too far, as Calamos describes it. And as so often, the devil can be in the details here. So in the next section of today's video, we will walk through an example of how an autocallable might behave over its life, because there are several possible outcomes and scenarios. But before we do that, and to better understand how autocallables are structured, let's consider the other side of the trade. Because 14.6% is an attractive return, you can see why someone with the risk appetite might be interested in investing in autocallables. But why would someone issue an autocallable and offer such high coupons in the first place? Well, the main reason for issuing an autocallable is typically to buy some downside protection for a certain stock or an entire equity portfolio. An autocallable essentially can be like an insurance policy for the issuer. If the value of an equity investment or index goes down too much, someone will take the position off them for the original price or make them otherwise whole for their loss. For those of you familiar with options, this is the same economic purpose why someone would pay a premium for a long put, to buy insurance against a drop in the value of a stock or a portfolio of stocks. And in the case of the autocallable, it's the investor in the autocallable who'll do that and insure the issuer against potential losses, so to speak. That's the underlying trade. High coupons for the autocallable investor in return for the promise that the investor will absorb losses from a bad equity market for the issuer. As promised earlier, let's walk through an autocallable example from Marecube's website to show you what we mean, because it's not exactly straightforward. And as a reminder, the Marecube US Large Cap Full Advantage Autocallable Index is the autocallable index that the Calamos Autocallable Income ETF, CAIE, is based on. How do autocallables work and what are the risks? So here's the chart we took from Marecube to show you the several possible outcomes and scenarios that could play out over the lifetime of an autocallable investment. This is an example for a 5-year or 260-week index-based autocallable. And it is a hypothetical example, even though key features such as the no-call period, maturity, and barrier levels are the same as for the actual autocallables that underlie the Calamos Autocallable Income ETF, CAIE. The light green line shows the index that underlies the autocallable note, for example, the S&P 500, or a similar index like Marecube's own large cap index. Autocallables are generally issued at par, meaning the index is at 100% on day one. And this 100% is also the auto-call barrier, the dark blue line here. The autocallable has a no-call period of 1 year, meaning that it will not be automatically called for the first year. After the 1 year mark, however, the auto-call feature sets in, And if the index is above 100% at the 1 year or 52-week mark, the note is called. The investor gets the full principal back plus the coupon for the first year, but now has to find the next investment at whatever the current market conditions will be, exposing him or her to reinvestment risk. And with the no-call date of 1 year expired, there will now be regular observation dates going forward. For example, monthly in our case. And whenever the index will be above 100% on one of these observation dates, the note will automatically be called, and the investor will get back the principal plus any outstanding coupons. Of course, this again creates reinvestment risk and takes away some potential upside from the investor. Because as I just explained, if the index does well and climbs above the price at issue, the note gets terminated just when the autocallable looks more attractive to the investor, paying potentially high coupons while being safely away from the loss zone. But of course, that's exactly the reason why the note will automatically be called by the issuer. The whole point of paying the high coupon on the autocallable was so that the investor could help the issuer shoulder some of the losses if the index falls. If the index isn't falling, but rather going up, then the issuer doesn't need the insurance and will not want to keep paying the high coupons to the investor. So, that explains the autocall feature with the initial 1 year or 52-week no-call period, as well as the scenario if the index moves above 100% after 52 weeks. And this short blip here on the chart where the index goes above the 100% for a short period of time, this shows that the note only gets auto-called if the index is above 100% on one of the monthly observation dates. If the index is above 100% just for 3 weeks or so in between two of the monthly observation dates, nothing happens. The note will not be automatically called even after the first year, but continues to pay the high coupon, as long as the index stays between 60% and 100% in our example. But why these two percentages, right? Now, we already know that the note will be called early if the index is above the auto-call barrier of 100% at any observation date from now on. However, there's another limit to consider: the coupon barrier, the line in light blue here that is set at 60% of the index value in our example. If the index value falls below the coupon barrier of 60% on any observation date, no coupon is paid for this period, like at this downside point here. However, coupon payments will usually resume once the index value rises above 60% again at the next following observation date. The reason for the non-payment of the coupon if the index falls below the coupon barrier is that at this point, the first step of the downside protection for the issuer kicks in. The index is now below 60% of its initial value, and the issuer is sitting on some unrealized losses. And not having to pay the often high coupons anymore is the first mechanism that helps mitigate the potential loss for the issuer. Of course, it's the opposite for the investor in the autocallable. Just as the index gets into danger territory, the nice coupon payments stop coming. But that was part of the initial bargain. Note that we haven't spoken about potential losses on the principal yet. We're getting to these now. Every autocallable has not just a coupon barrier, as we just discussed, but a principal barrier as well. In our example, the principal barrier is set at 60%, exactly the same level as the coupon barrier here. But they could be different percentages as well. The principal barrier is, in most cases, such as in our example, not really relevant during the lifetime of the autocallable. Even if the index falls below the 60% during the life of the note, nothing really happens to the principal. Now, the nice coupons may stop coming if the index falls below the coupon barrier, as we just discussed, but the principal barrier is, in most cases, only really relevant at maturity, after the full 260 weeks, or 5 years. So, at maturity, there are really two possible outcomes for the principal repayment, and it's binary. If the index value is above the principal barrier at maturity, the 60% in our example, the investor gets back 100% of the principal, regardless of the actual value of the index. In other words, all losses in the index above the principal barrier are the issuers, and the investor in the autocallable does not share. However, if the index falls below the principal barrier, all the losses will be borne by the investor in the autocallable. The principal repayment will only be equivalent to the index value. So, for example, if the index falls to 45% of its initial value at maturity, the investor of the autocallable will only get back 45% of the principal, meaning the investor has to carry the entire loss of 55%. And of course, this scenario is exactly why the issuer sold the autocallable in the first place, to be protected against principal loss in the case of a severe market downturn. And in the worst case, if the index were to fall to zero, the entire principal would be lost for the investor in the autocallable. So that's how an autocallable works. In the best case, in our example, if the reference index does go down a bit, but not too low, essentially staying between 60% and 100%, the investor gets nice regular coupon payments in cash for the full 5 years and then the entire principal back. And if the index does well and goes above 100%, the note gets called early, but the investor gets back the full principal plus any outstanding coupon payments. But in the worst case scenario, if the index were to drop below the coupon barrier of 60% at the first observation date and then goes down to zero at maturity, the investor could basically lose his or her entire investment. There would be no ongoing coupon payments as long as the index remains below the coupon barrier, and there would be only a partial or worst case, no repayment of principal at maturity below the principal barrier. So the risk of an autocallable is that the investor becomes basically an insurer against a steep drop in the stock market in return for potentially nice coupons like this 14.6% shown by Calamos. On the flip side, however, autocallables protect the insurer against a black swan event in the stock market, a severe market crash, which in the case of this example means if the market drops below this 60% coupon and principal barrier, meaning it falls by 40% or more. Smaller losses above the barriers will still be borne by the issuer. This means that autocallables may be one of those investments that perhaps are a bit binary, as I mentioned earlier. They look really good while they look good, but if they go bad, they go really bad. So what do you think? Are you still interested in learning more about autocallables and the potentially very nice coupons and cash income, like this 14.6% here from Calamos' Autocallable Income ETF, CAIE? Or are you more concerned about the almost black swan-like downside risk that autocallables are designed to protect the issuer against? Drop a comment below and let me and the community know, because again, the answer is not always straightforward here and will depend on a host of factors. For example, when we look back at historical market performance, keeping fully in mind that past performance is not indicative of future results or events, how often and when has the market fallen by 40% and stayed there over an extended period of time? In any case, if you are interested in learning more about autocallables and specifically how the Calamos Autocallable Income ETF, CAIE, works as a fund, then be sure to check out this month's member video here on CAIE, which will be posted in a few days' time and which we will link below in the first pinned comment as soon as it's out, because we've just scratched the surface on CAIE today. And while CAIE is the first 14.6% autocallable income ETF to hit the US retail market, it may not be the last. There are already 2 others awaiting approval from what we could see. And in this member video, I'll also walk through some additional factors to think about before diving into CAIE for those of you who are considering a possible investment and whether we would personally invest in CAIE. Our next live member Q&A is also happening this Friday, July 25th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. So come join us for that as well. And for those of you who would rather stick with straightforward and predictable instruments, and want to learn more about bond investing and building out a bond portfolio while rates are still attractive, then check out this video here on our bond courses, because rates haven't been at these high levels on average in decades. All right, members, super savers, and bond course fans, I hope you enjoyed today's video and learned something new. And as always, I've linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.